Today, a completely different subject matter to an earlier live. But today we're talking money. In fact, the 5 F words, we're going to get those, the 5 F words in today's mortgage market. And my guest today is Campbell Hastie. How are you going, Campbell?
Good. Kia ora. Hello.
Nice to have you here. You're sounding good. You've got a lovely setup
I've
there,
got
haven't
all
you?
the gear, haven't I? Yeah,
You
yeah.
have
I'm
indeed.
feeling
You can
professionally
hear
sorted.
yourself.
Yeah,
Excellent.
beautiful.
Uh, as per usual, if you're joining us on the live, please use the comment section below this video on LinkedIn, Facebook, YouTube. I think we're going out on Twitter and some Facebook groups as well. If you have a question for Campbell, please drop that question. Anything to do with the mortgage market for the next 20 minutes or so, we are talking conversations around getting money, particularly for first home buyers. Would that be correct, Campbell?
Yeah, I think so. Yeah, we'll go into that.
All right, we're going to go into we've got a whole bunch of questions for you. Before we do that, who is Campbell Hastie?
That's a pre-prepared question, isn't it? I've been thinking about that over the last 24 hours, really. And John, I think it boils down to this. A lot of people talk about what they do and they relate themselves to that. But for me, it's about my roots, I suppose. That's really important. And look, I started out as just a little Maori kid from the East Coast. And if you can imagine the opening scenes from the movie Boy, that actually describes me as a young fella. So that's where I come from. I'm made of that, if you like. But I'm the little Maori kid that went to Auckland, came to the big smoke, got a couple of degrees, found himself doing this almost by default. And yeah, here we are, gosh, nearly 20 years later, having built I think, a successful mortgage practice. And yeah, that's kind of it in a nutshell, I would say.
And you've got, you practice what you preach. You've built a little, we'll call it a little, a company, or like you've bought and sold a number of times. Do you want to share a little bit about that?
In terms of my
Well,
involvement with property,
building,
you mean, or you
yeah,
mean the business side of things?
correct. Well, I think for you personally, building your little mini empire of property. So you practice what you preach, right?
Yeah, I do. Yeah, I do. I've become a fan of property over the years. I learned a little bit about it when I was at university. I remember reading a book by a guy called Dolph DeRose, and if there are any property investment people out there, they'll probably be familiar with that name. And read that book, and it was a bit of a life changer. It's one of those ones that you read and go, wow, a few light bulbs went off. I didn't actually do anything. I didn't pick up on his advice probably for another 15 years after that. But I understood the concept of getting involved with an asset class that would grow in value and that would pay for itself. And then you read about this sort of stuff if you read other books like the Rich Dad, Poor Dad series, that sort of stuff, and the cash flow quadrant. An asset's not an investment unless it produces income. Otherwise, it's just a hobby or a hole for your money sort of thing. So you start to understand those sorts of things. And yeah, I ended up getting involved with rental property. I'm not a big time property investor or anything like that. I don't have 50 properties or anything crazy. I've got a few, and that's good. And they've been good to me. And really, the thing I've learned from that is that at the end of the day, you've got to get involved with something, have a plan behind you, and stick at it long enough for the rewards to appear. And actually, it didn't take all that long. Good old Auckland property market and capital gain, everyone will have a sense of what that looks like. So I've managed to, benefit from that. But yeah, I'm someone who is in favour of property. I love it. And, I can talk the talk when people approach me about wanting to get involved themselves. I don't just talk to them about getting the money, borrowing the money, the mortgage money to do it. It's about the other stuff that goes around it too. And I think it's a big value add for people who, come and talk to me about that sort of stuff. My real focus, I suppose, though, in terms of the mortgage stuff that I do, is the first home buyer. I love talking to that group of people. I remember what it was like myself. And I often tell the story to to customers who are buying their first house or have bought it. Usually, they have bought it, and I say to them, you'll have this moment probably when you're unpacking the boxes, or maybe when they're all unpacked, just as I did, because I remember stepping onto the back deck. It was a couple of days after we'd moved in, Kirsty and I, our first house. And I had a cup of tea in hand, looking out at the sun and just the morning, and looking around, thinking to myself, you know what? This place is all mine. It's all mine. And there was a funny realization that sort of happened, and you get a little tingly sort of feeling in your stomach. I can actually feel that happening now, strangely enough. It's almost 20 years ago. But that cool moment, I try and relate that to everybody, because you should try to remember it. It'll happen. It does happen to everybody. You should try and remember it, and just let it flow over you, because it's a very cool moment. And so that's one of the reasons, I love talking to first home buyers, because I just remember that feeling myself. So, and yeah, John, I've been fortunate enough to build a mortgage practice around that. It's cool.
So take us back. Why? People like to know those questions. Why are you a mortgage advisor?
But to start with, I actually fell into it not exactly by accident, but another one of those realizations that I had in the job that I was working at the time. That boss basically pissed me off. So I said, right, this is it. I'm out. And I realized that the mortgage world was a rosy place to be. This was back in the mid 2000s, 2004-05, and a property boom was happening at that point. And so it looked like it was a good place to be. People were making some dollars. I was actually in the life insurance industry back then, and I was a sales manager for a life insurance company. And that was a really good job, actually, apart from that particular manager. Bygones. And anyway, it looked like, as I say, it was a rosy place to be. And so I essentially set myself up, because I thought, no one's going to come and knock on my door and say, Campbell, I want some life insurance. Although they sometimes did. But they would if they wanted to buy a house and I could arrange the mortgage for them. And I remembered what that feeling was like. I was just talking about that, about getting my first place. And yeah, that's kind of how it came about. That's I guess why I do what I do. Everyone likes to be needed and wanted, and that's what happens when my phone rings on a Monday morning. People go, Campbell, can you help me with a house or a renovation or whatever it is?
Well, I think you already said your why. That lovely story that you just painted right then about getting your first one, and you like having conversations with first home buyers. So let's talk about those 5 words. There are as many things that we can have a yarn about in the mortgage market. We're going to start with those five words. They're almost acronyms, aren't they? What's the first one?
Yeah, they are acronyms. The first one, well, before I tell you what the first one is, the F in all of them stands for fear. And there's a lot of fear that goes, there's a lot of emotion that comes with operating in the property market. You see it in the newspaper all the time. Every headline is an emotive one. So the 5 F's here, the F stands for fear in all cases. And so the first one we talk about is FOMO, the fear of missing out. That's something that everyone's really familiar with. It's kind of past, actually. The current market is not filled with FOMO, although it was only recently that it was, about 12 months ago. And again, I could tell you a story there about Kirsty and I having sold our house, and approximately 12 months ago now, almost to the day actually. And we'd sold our house, needed to get ourselves a new one. And the settlement day arrived and we hadn't found one. And talk about there was a genuine fear of us not being able to get a house. Where would we go? All of the problems that came with that. What would we do with the cat? What would we do with all of our stuff? Where would I park the boat? And you go to an open home and it's like going to the number one shoe warehouse. There's just a whole lot of footwear outside because everyone else is feeling that same fear. As I say, that's not something that's part of the market now, but desperation. Oh my God. That's definitely a fear that people have in the market. well, they can have that fear for sure. It's subsided, as I say, but it is there. But it's been replaced now with FOOP, the fear of overpaying. Right? Have you heard that one? It's followed pretty closely by its running mate. I'm not paying that. I don't know how you say that as an acronym. I'm not paying that, but FOOP. And we've all got this now, right? Because there's a sense that prices are softening, I suppose you'd say. And so the problem with that one is that rather than taking action and actually buying something or making an offer, you kind of freeze and go, oh, if I pay this now, maybe I could have got it cheaper tomorrow or maybe next month. And so everything slows down. And that's exactly what we're gripped by now. It's that, what's that fear, of paying too much. And really, you've just got to get on with it, people. You just do. The other fear that I really want to unpack this one today is fobbed. It's not the fear of being fobbed off, but FOBD, fobbed. So that's the fear of being declined for a mortgage. And, I see that one a lot. And the interesting thing about that is that people do freeze. I often hear it when people say to me, oh, look, I don't want to waste your time. I'd like to buy a house. I'm thinking about getting a mortgage, but I don't want, no, I don't. It's the fear of rejection there. And I just say to people, look, give me your stuff. Let's have a look at it and see what you can actually do. 9 times out of 10, that group of people can actually do something, and you can frame it up. But there's this real fear that, people are going to be declined by the bank. They've heard the stories about the triple CFA and the bank criteria becoming a whole lot tougher, and they think, oh no, I won't do anything. And this is not just first home buyers, by the way. This is everybody. Here's this fear in an extreme example of this fear, right? So this lady, she said to me, look, I'm so scared of spending anything, because if I do spend and the bank think I'm spending madly, then I'm going to get declined for that loan that I need so I can, in her case, she was purchasing a section to buy a house. She was so scared, she didn't even buy her kid anything for his birthday, right? No, honestly, I'm not making that up. She was so just frozen by it. I said, oh, Mel, come on, it's okay. The bank's not going to kill you for that.
So how much are they looking at that, from looking at all of your applications, so let's say over the last 4 months, or just at least for this year? What are they really looking at? Are they declining if you're having, too many nice coffees from Daily and K Road?
Long story short, no, they're not. In a nutshell, they are looking very closely at it though, and the underlying assumption is that past behavior is predictive of future behavior, right? So if you've got a KFC habit now, it's likely that you'll have a KFC habit in the future. You can put it like that. But within that, as a mortgage advisor, I've got the ability to have a really robust conversation with a customer and say to them, look, what could be trimmed here? What would you be prepared to sacrifice in order to get that mortgage? How far would you go? And we can dial that back to a point where it's reasonable. I don't think you can dial someone's KFC habit out of existence, because that's going to carry on, right? Everyone's going to enjoy going out, not the KFC thing, it's the going out thing and having some sanity time. So we're able to have that conversation with a customer and propose to the bank accordingly. And we've been successful on that basis, okay? The key is that you've got to understand, and like everyone knows, that if you've got a mortgage, you will die in the ditch before you lose that house. You will. You will trim everything you can back. Generally speaking, most people behave that way. And so if that's how it's going to be when push comes to shove, at the end, then why would that not be the case up front? So yeah, that's the solution to it, really, having that conversation and having dug deep into someone's financial life, I suppose, and help them understand exactly where they're at.
And you
Right?
love that. You love that process. You love looking at all that information and then being brutally honest with them and saying, this is what you can afford, or this is what you can't afford. What about any stories relating to, I don't know, you're not mentioning you're protecting your client's details, but have you got any examples of potentially some of the things that are declined?
I'll say this. The stories that you've seen in the newspaper where someone's coffee habit has meant that the bank has declined their loan application, those people, by and large, have struck me as candidates who are not very strong borrowing candidates at all. So if it wasn't the coffee habit, it would have been something else. I saw one of those newspaper articles where it said the customer was looking for something like a $30,000 top up so they could do some renos at their house. And they had a mortgage which was relatively modest as well. It's about $100,000. So they're asking for $130,000 in total. And if you are a person whose coffee habit is going to bugger up your chances of getting a mortgage when your current liability is this big, you're not the strongest borrowing candidate in the world, right? So most people aren't in that category. And that fobbed fear should not be something that makes everybody freeze. Shouldn't be.
That was 4 Fs. The fobbed. Is there a fifth one? Is there a fifth fear?
Yes. One, two, three, four. I've actually got 6 on my list.
You've got
a
six.
spare. I've got a
6
spare.
Fs.
Well, two of them are kind of related. There's two there. One's called fongo, and the other one's called fongi.
Fongo and fungi.
Not to be confused with fungi, the mushroom stuff. Fongo is fear of not getting out, and fongi is fear of not getting enough. So the fongo relates to people who are property investors, right? They've bought at a certain point. They need to sell for a certain amount in order to get out with a profit. So the fear of not getting out, and that's a very real one right now, I think, for some people because market conditions have softened. And the fongi, fear of not getting enough, similar, but for owner-occupiers, can't sell their property for enough in order to be able to make that next step. Or they won't be able to, their next step won't be as good as what they had hoped for. In terms of addressing both of those fears, I'd say to people, you really need to know your numbers inside out, and then you need to make the step anyway. Because in property market is a game that operates over long time frames. Over time, things always correct themselves. That's true even if right now you're sort of looking at it going, oh my God, am I going to get out of this? Everything's going a bit soft. Rates are going up. Inflation's up the wazoo.
But you were saying that in another earlier conversation about inflation, it's actually property is inflation proof, right?
Well, inflation is the kind of thing that affects all goods and services, right? It's just a question of how much each one is affected. But it's not the only impact, not the only factor that impacts on property prices. Interest rates are a key one. But yeah, overall, all things being equal, if inflation is 7%, it means everything's going up in value by 7%, like it or not. Includes property too, you'd have to think. But again, it's not the only factor. So the world's a little more complicated than that.
It is always more complicated. There we have the 5 F words in today's mortgage market. How do people best engage with you? What's the easiest way for people to do you have a calculator on your website?
And we do have a calculator on our website, and this is targeted at first-time buyers, and it's designed to assist you to understand what your borrowing capacity looks like. I would say to most people, use the contact form on our website, hastiemortgages.co.nz. Go there, Google Campbell Hastie, you'll see me pop up. use the contact form and ask me a question. Tell me what's on your mind, really, and I'll come back to you and help you understand that question. We might do a bit of number crunching as well. Yeah.
Good. Anything else you want to add to your 5 F words today, Mr. Hastie?
Oh gosh, should I talk about the last one?
Oh, is there one more?
Well, number 6, the spare. Have we got a little time? I think
We've got time. We've always got time for you.
The last one, I think I made this one up myself. I am not the author of the others, but filth. Filth. Yeah, I know. Filth. This is fear I'll lose the house. Fear I'll lose the house, right? And this fear actually relates to some of the things we've been talking about. Inflation going up, interest rates going up, the cost of everything else going up, and the squeeze coming on to people's budgets. There is a squeeze going on right now. There's no question. We've got people who, their loan repayments are going up by $400, $500, $600, $800 a month in some cases, and it's going to be noticeable. And so that fear that they'll lose the house is a natural one, actually. But there's some ways that you can manage that risk, that fear. And the primary one that we tend to employ, excuse me, is really simple. It's by, God, I'm going to let the secret out of the bag here. This is my IP, John. The solution is really simple, or a potential solution is really simple. And that is to break your loan into a couple of pieces and have a different fixed interest period on each piece, so that when an interest rate increase comes along, you're not smacked on the whole lot. You're only impacted on, say, half the mortgage or a third of the mortgage if you've broken it 3 ways. We've done that for lots and lots of people, and it's kept them safe, because the reality is that you can't avoid the increase that's coming, but you can manage your way through it. And that's one way of doing it. And that will help you avoid the fear of losing the house. So, yeah, there you go. There you go.
Indeed. If you have any questions for Campbell, Campbell at hastiemortgages.co.nz, or send me a DM. We'll put you in touch with him. But do jump on to his website to use that contact form or the mortgage calculator. He'd love to help. Thank you for your time today in the 5 F words. And of course, if you have a question, we will be chatting to Campbell next month. If you have a question that you'd like me to pose to Campbell around if you're a first home buyer, we would love to have that conversation. You have a good afternoon.